If you've ever said, I want to invest in the stock market, but have no idea where to start, then this video is for you. I remember when I was first learning to invest in the stock market, I had so many questions. I didn't know what a ticker symbol was, what the different prices meant, where do I even buy these stocks at, what exchanges. These were just a few of the questions that I had. The first thing that you need to know is what is a stock? So, a stock is ownership in a company. When you buy a share, you own a tiny piece of that company. So if the company grows, your stock value can go up. So for an example, let's look at Papa John's here. So let's pretend that this whole pizza represents his whole company just starting. And let's say that he's doing really well. He needs to expand his operation, maybe build some new um, pizza places. He has some different operational expenses. So he issues out shares to raise some money. So each slice represents a share of the company that he's issuing out. So there's 8 slices. So there's 8 shares issued out. And so if you were to buy, let's see here, doing this on my trackpad, so it's a little difficult. Um, Half the pizza right here, you would own 50% of the company because you bought half half the shares that were being issued. So if you were to buy one, two, three, four, five, 6 shares, you would own 3/4 of the company. So let's say, for example, on January 20th, 2025, you decide to buy one slice, which is 1 share right here of the company for $41 per share. And within 3 months, you sell this for March 15th, 2025. Let's say the company's doing really well. And this goes from $41 per share to $67 per share. So what you would do is you would take the current sell price at $67 minus your buy price at $41 per share, which would give you a total gain of $26 per share. How do you make money in the stock market? The simplest way is when the stock goes up, you sell and take a profit. You could receive dividends where a company pays you just for holding shares. And you could also use dividends to buy more shares, which equals compounding. So, for example, let's look at Apple stock. Right now, it's currently trading at $224.76. The market's still live right now. It's only 3:30, so this price is going to be constantly moving. So if you wanted to buy 1 share of Apple, it would cost you $224.75 currently, and this will change throughout the day. So let's just say you got it at $224.76. If this suddenly shot up $100 to $324.76, you would then make $100 because you bought it for $224.76 and it shot up to $324.76. So you can see here on the right hand side, I currently have a bunch of ticker symbols of stocks. So PayPal is currently trading at $69.09. So if you wanted to buy 1 share, it would cost you this much. Tesla is trading at 277.87. So that tells you how much 1 share costs. Microsoft, Netflix, Meta, so on and so forth. So you can see exactly how much 1 share would cost. If you wanted 5 shares, you would just multiply it out by the price to see exactly how much it would cost you to get 5 shares or however many shares you're looking to get. So let's talk about dividends for a second. So companies that pay you just for holding shares. Here's a little example for you guys. Let's say you buy 10 shares of a company called Sunny Sodas. Each share costs $10. So you invest $100. So you get 10 shares. Now, Sunny Sodas is a profitable company and wants to share some of its profits with its shareholders, which would be you. There's a dividend announcement, and Sunny Sodas announces a dividend of $1 per share. Since you own 10 shares, this is what you'll get. So here's your $1 per share in dividend that you received times 10 shares, which is $10. So that that $10 is your dividend payment just for owning the stock. Like, here's thank you just for owning the stock. It's pretty awesome. The one thing I really like to do when investing in dividend stocks is just keep reinvesting the dividends. So if I receive a $100 dividend, I put it back into that stock, which buys more of it, more of the stock. And then maybe 3 months later, I'll receive a bigger dividend check and I'll put that money back in and I'll buy more of that same stock. So it's just like a giant snowball rolling down a hill, compounding, getting bigger and bigger. Um, One of the bigger dividend stocks that many people are aware of is SCHD. This pays out every quarter, so every 3 months. So you could see here there was a dividend paid out in December 2024. It was 26 cents. Here we go for March. It's 24.9, so almost 25 cents. So you guys can see here the current price is 27.78. So for every share you own, you're getting paid this amount just for saying thank you for holding these shares. So let's say you had 1,000 of these shares, which would cost you 27.78. Here we go. Whoop. Here we go. Okay, $27,780. That's how much 1,000 shares would cost you. So you own 1,000 shares. You're getting paid this amount for the dividend times 0.24. So you're getting $249 just as a thank you for holding these shares, which is pretty awesome. So you're probably wondering what the heck SCHD even is. It's not like Tesla, which is an individual stock. It's not like Meta, which is an individual stock. SCHD is comprised of 100 of the highest yielding dividend companies out there. So if you look at SCHD right here, you're going to see this is an ETF, which is pretty much like think about an ETF as a basket of stocks. It's not just one individual stock. There's a whole bunch of stocks that make up the ticker symbol, which can consist of stocks or bonds. But specifically with SCHD, it's high yielding dividend stocks. So here is SCHD. You'll see the top 10 holdings. We got Coca-Cola in here, Amgen, Cisco, Pfizer, Verizon. The list goes on. And like I said, there's 100 different holdings within SCHD. Another popular ETF is the VU. So we type that in here, the Vanguard S&P 500 ETF. This is comprised of approximately 507 different stocks, which is nice because, you know, if you're invested in one stock, for example, let's say you're invested in Tesla up here and all your money is in Tesla and you bought in right here and you have this massive drop, you're going to lose out on quite a bit. Whereas if you're invested in an ETF, like the VU, which is comprised of 507 stocks, that's being held up by all those different companies. So all those companies would have to crash at the same time, potentially for you to lose like a massive amount of money. And so it's been, you could see right here, here's the weekly chart. It's been pretty consistent. Each one of these candles represents 1 week. You could see right here how it's just kind of trickled up. And here is the VU, the Vanguard ETF. Here's the top 10 holdings: Apple, Nvidia, Microsoft, Amazon, Meta, so on and so forth. Another popular one, SCHG, which is an ETF. This is comprised of approximately 229 different companies. So you could see a lot of the similar holdings: Apple, Nvidia, Microsoft. You could see the price difference. The VU is 521.23, where SCHG is $25.68. So that's why, as a beginner, a lot of people will pick ETFs because they don't have to try to figure out which stocks to pick. They just pick, VU, which consists of all those companies, and they get a little slice of action in each one of those companies. They own a little portion of them, versus putting all their eggs in one basket, so to speak, with different stocks like Microsoft, which is individual company, PayPal, um, Meta, JP Morgan Chase, so on and so forth. So that's why a lot of individuals will look for those ETFs when they're first starting out. So they don't have to try to guess which stock to pick. How much money should you invest in the stock market? That's going to depend on each person, what expenses they have, the amount of income they have coming in. Everybody's going to be different. I always suggest dollar cost averaging. Here's a little example of dollar cost averaging. So let's say you invest $100 every month in a stock or ETF on the first of every month, no matter what the price is. So here's how it could look over 5 months. So January, the stock was $10. You bought 10 shares, you have $100 total invested. The stock price was $8. You got 12.5 shares, you invested $100. March, $5. Stock price, shares bought 20, $100 spent. April, May. So you guys could see you're spending $100 each month and kind of averaging out the price overall. So you can see your average share price is $8. So if you take your average cost per share, which is your cost, which is $500, and divide it by how many shares that you bought, you could see how much your average cost per share is. This is really good versus dumping, like 40 or 40,000 or 10,000 or something crazy in during the month of January when you see the price kind of dip down in February, price dipped in March. So this is called dollar cost averaging, and it's super beneficial and helpful. When I first started trading, I just opened up a separate checking account through my bank and then linked that checking account to my Charles Schwab account. So then I would just take money from my savings, put it into my trading checking account, and then transfer it from my checking account right into my Charles Schwab account. There's tons of different platforms out there. If you guys look online, you'll see Charles Schwab, Fidelity, E-Trade, Robinhood, Webull, there's Vanguard. There's tons of different options out there. You just have to find which one's the best fit for you. The number one saying I've always heard is time in the market beats timing the market. So, if you're a long-term investor, just stick with your plan, stick with your game plan. If you're day trading, no matter what you're doing, make sure you have a plan. Don't invest money you need the following month. Don't panic sell during dips. Start slow, stay consistent, and best of luck on your journey. If you guys like this video, please click the like button, subscribe, and we'll see you next time. Thanks, guys.